Hello all. Time for a short video focusing on credit sales and the need for estimating bad debt expense. We are a consulting firm in our first year of operation. Our accounting records will follow generally accepted accounting principles, or GAAP, and as such will be accrual based. Our revenue account is titled consulting fees. All services provided are on account with payment due within 30 days or net 30. We record adjusting entries each quarter before preparing our quarterly financial statements. We operate on a calendar year basis. For the months of January, February, and March, we reported revenue of $400,000. During those months, we collected $300,000 from our customers. Because the revenue recognition principle states that we record revenue when services have been provided and earned, and not when cash is received, the revenue for the first quarter is $400,000. A journal entry and general ledger posting to summarize the first quarter revenue includes a debit to accounts receivable and a credit to consulting fees for $400,000. The cash receipts for the quarter were recorded by debiting cash for $300,000 and crediting accounts receivable for $300,000. While our intention is to collect 100% of the amount owed to us, as managers, we realize that we will not collect all of our receivables. Some customers will never pay. Because we follow GAAP and accrual basis accounting, we need to estimate the uncollectible amount and record an adjusting entry each reporting period, which in our case is quarterly. This is referred to as the allowance method. We are basing our estimate for uncollectible on the current balance of accounts receivable. This is referred to as the percentage-of-accounts receivable method. We are optimistic and estimate the uncollectible percentage to be a low 2%. For the first quarter, the estimated uncollectible amount would be 2% times the current balance in accounts receivable, which is $100,000, for a total of $2,000. When recording our adjusting entry, we debit bad debt expense for $2,000 and credit allowance for uncollectible accounts, which can be abbreviated AUA, for $2,000. The accounts receivable account is not reduced directly because none of these receivables have been determined to be uncollectible. The allowance for uncollectible account is credited instead. Let's take a minute to discuss the allowance for uncollectible accounts, or the AUA. The allowance for uncollectible accounts is the account that companies use to report the estimate of future bad debts. It is a contra asset account. As a contra asset account, it will increase on the credit side and have a credit balance. As a contra asset account, it will be subtracted from accounts receivable to get net accounts receivable. Net accounts receivable, then, is the amount that the company expects to collect from its customers. Accounts receivable, allowance for uncollectible accounts, and net accounts receivable will always be reported in the current assets section of the classified balance sheet. Like accounts receivable, the allowance for uncollectible accounts is a permanent account and will have its balance carried forward to future years. The other account involved with the adjusting entry is the bad debt expense. The bad debt expense is the amount of accounts receivable that a company estimates to be uncollectible during a specific accounting period. It is the cost of future bad debts that is reported as an operating expense on the income statement. The bad debt expense is recognized because of the matching principle. The matching principle tells us to match the expense with the revenue that it helped generate. It's all about cause and effect. The bad debt expense is recorded at the time that the revenue has been earned. So for the quarter, we will recognize $400,000 in consulting fee revenue and an operating expense of $2,000 labeled bad debt expense on the income statement. On the balance sheet, we will report $100,000 in accounts receivable and the contra asset labeled Allowance for Uncollectible Accounts of $2,000. The allowance for uncollectible accounts will be deducted from the balance in accounts receivable to get accounts receivable net, which is also referred to as the net realizable value of accounts receivable. For our company, the accounts receivable net to be reported on the balance sheet is $98,000. $100,000 in accounts receivable minus the contra account known as Allowance for Uncollectible Accounts of $2,000. During the second quarter, we reported $500,000 of revenue and $450,000 of customer cash receipts. After journalizing and posting the revenues and receipts, the balance in accounts receivable is $150,000. The first quarter balance of $100,000 plus the $500,000 in revenues during the second quarter minus the $450,000 in second quarter cash receipts. Again, the estimated uncollectible amount is 2% times the balance in accounts receivable, which is currently $150,000. 2% times $150,000 is $3,000. So we need a balance in the allowance for uncollectible accounts of $3,000 at this time. Since the allowance for uncollectible account has a credit balance of $2,000 already, our adjusting entry for the second quarter is not $3,000, but $1,000. The $1,000 needed to increase the balance from $2,000 to $3,000. We debit bad debt expense for $1,000 and credit allowance for uncollectible accounts for $1,000. Once the amounts are posted to the general ledger, the bad debt expense for the quarter was $1,000. And for the year to date, it will be $3,000, which is the sum of quarter one and quarter two. The allowance for uncollectible account balance is now $3,000 or $2,000 plus $1,000. The accounts receivable net at the end of the second quarter will be $147,000 or $150,000 of accounts receivable minus the balance in allowance for uncollectible accounts of $3,000. Notice that with the income statement, consulting fees were $400,000 for the first quarter, $500,000 for the second quarter, so we have a year-to-date total of $900,000. On the other hand, bad debt expense was $2,000 for the first quarter, $1,000 for the second quarter, and as a result, $3,000 year-to-date. Income statement amounts for year-to-date always represent the total of all quarters being reported. Balance sheet information, on the other hand, is always reported at a point in time. We will not sum the quarters. We'll report the quarter end information. So at the end of the first quarter, which would have been March 31st, our accounts receivable net would have showed up on the balance sheet at $98,000. For the quarter ended June 30th, our accounts receivable net will be $147,000. The balance sheet is a picture of balances at a point in time, and that's exactly what we're doing here. During the third quarter, the economy suffers a downturn, and we report decreases in both revenue and cash receipts. For the quarter, consulting fees totaled $300,000, while cash receipts from customers totaled $200,000. Because of the downturn, several customers are unable to make any payment. We determined that we need to write off $5,000 of customer accounts due to company closings. Once you determine that a particular customer's account is uncollectible, the next step is to remove the balance from both the allowance for uncollectible accounts and the customer accounts receivable balance. We know that the customer will not be paying us. To write off the account, we debit the allowance for uncollectible accounts and credit accounts receivable for $5,000. The third quarter journal entries and general ledger postings include the debit to accounts receivable and credit to consulting fees for $300,000 of revenue. There's also a debit to cash and a credit to accounts receivable for $200,000 of customer cash receipts. The write-off required a debit to the allowance for uncollectible accounts and a credit to accounts receivable for $5,000. That entry was used to write off the uncollectible customer amount. After journalizing and posting the revenue, the cash receipts, and the customer write-off, the balance in accounts receivable was $245,000. We had the quarter two ending balance of $150,000. We added the $300,000 in revenues. We subtracted the $200,000 in cash receipts and the $5,000 in charge-offs. That's how we got that $245,000. Again, the estimated uncollectible amount is 2% times the accounts receivable balance of $245,000. 2% times $245,000 is $4,900. Because of the write-off, the allowance for uncollectible accounts has a debit balance of $2,000. Our adjusting entry for the third quarter needs to be $6,900 to increase the balance from a $2,000 debit to a $4,900 credit. The balance in the allowance for uncollectible accounts after the adjusting entry always has to be equal to the 2% times the amount in accounts receivable at the end of the period. We debit bad debt expense for $6,900 and credit allowance for uncollectible accounts for $6,900. Once the adjusting entry is posted to the general ledger, bad debt expense for the quarter is $6,900. And for the year to date, it is $9,900. The allowance for uncollectible account balance is now $4,900. The income statement now reports consulting fees for the quarter of $300,000 and $1,200,000 year to date. The bad debt expense for the quarter was $6,900, and for the year to date, it is $9,900. The balance sheet reports accounts receivable net of $240,100, as accounts receivable totaled $245,000, and the allowance for uncollectible account balance is now $4,900. $245,000 of accounts receivable minus the allowance for uncollectible accounts of $4,900 is $240,100. And that's our accounts receivable net, or the net realizable value of accounts receivable. During the fourth quarter, we reported $310,000 of revenue and $300,000 of customer cash receipts. After journalizing and posting the revenue and receipts, the balance in the accounts receivable account is $255,000. The estimated uncollectible amount remains at 2% times the accounts receivable balance of $255,000, which is $5,100. Since the allowance for uncollectible account already has a credit balance of $4,900, our adjusting entry for the fourth quarter is for the $200 needed to increase the balance from $4,900 to $5,100. We debit bad debt expense for $200 and credit allowance for uncollectible accounts for $200. Once the amounts are posted to the general ledger, the bad debt expense for the quarter was $200, and for year to date, it is $10,100. The allowance for uncollectible account balance is now $5,100. The income statement now reports consulting fees for the quarter of $310,000 and $1,510,000 for the entire year. The bad debt expense for the quarter was $200 and $10,100 for the year. The year-end balance sheet reports accounts receivable net of $249,900, as accounts receivable totaled $255,000, and the allowance for uncollectible account balance is now $5,100. $255,000 of accounts receivable minus the allowance for uncollectible accounts of $5,100 is $249,900. Notice that the quarterly process remains the same every quarter. We record revenue. We record cash receipts. We check to see if there are any write-offs that have to take place, and then we do our adjusting entries. Know that accounts receivable and allowance for uncollectible accounts are permanent accounts, which means that their ending balance will be the beginning balance for the upcoming period. Consulting fees and bad debt expense are temporary accounts, which means that their balances, along with other revenues, expenses, and dividends, will be zeroed out through closing entries to retained earnings at year end, so that they can start the upcoming year fresh with no balance. Know too that there are three basic methods to estimating uncollectible accounts for an accounting period. The percentage of receivables method was illustrated here. The focus is on the balance sheet and the relationship of the allowance for uncollectible accounts to accounts receivable. The aging of receivable methods has the same focus, but recognizes that the longer accounts are past due, the less likely they are to be collected. Finally, the percentage of sales method focuses on the income statement and the relationship of uncollectible accounts to sales. Well, that's it. Hope this problem helps you with understanding how receivables and sales work. Thank you for viewing. Have a good one.